Wait for it. Wait for it. The ad is running for this live stream, and people will start trickling in right about now. And there they are. Hello, everyone. Welcome to another episode of Punch Card Investing. We got the full crew here today. Always a good day when that happens. Though I think next week is going to be a bit chaotic given the Berkshire annual meeting, which Tom will be attending. We'll have to talk about that in a bit. But before we get into today's episode, we'll be talking a lot about Netflix and the drama going on there as it continues to free fall after some pretty rough earnings. It's been part of a larger trend, I suppose, in their decline. But before we get to that, definitely check out the links in the description to Seeking Alpha. We got a discount link there. If you sign up using that affiliate link, we would get a commission as well, which would be great. If you sign up for their premium service, they have a free service as well for their articles. So check that out too. We also have ShareSite for portfolio tracking, which also has a free version as well if you want to try it out, see if you like it. And if you end up using the paid service using our link, you get a discount there too. And that would also go a long way towards helping the channel. So we'd very much appreciate that. Check out the Discord as well, Karan's merch shop, and all the great stuff down there in the description. Oh yeah, smash the like button as well. That's very important. That's the most important thing of all. How could I forget to mention that? All right, guys, let's dive into Netflix, shall we? Or should we just go right into it, or should we tease something else first?
No, let's do it.
All right. Do you want to start with Bill or just earnings?
Well, I think it makes sense to talk about the earnings first because Bill reacted to the earnings. True. I would say
paper-handed. So yeah, they had a negative subscriber growth. That's the headline. I got their letter right here.
Negative growth. What is that? There's got to be a word for that.
Shrinkage.
Shrinkage.
Here is their. Yeah, our revenue growth has slowed considerably as our results and forecasts below show, and they lost, I think.
Scroll up a little bit. It's in that table, Jack.
Oh,
I think it was 200,000 subscribers.
Yeah,
they've lost.
And they're predicting like 2 million loss for next quarter as well. So on net.
Yeah. Interestingly, though, they've still got revenue growth projected, even though the number of subscribers is dropping. So that's to do with pricing. Obviously, there's a fairly straightforward revenue model at Netflix with a number of subscribers and subscription price. So it's not too tricky to figure out why revenue is still growing there. But yeah, like you say, the headline is minus 200,000 subscribers. If you adjust for them basically pulling out of Russia, they did actually still grow modestly. So they lost 700,000 subscribers from leaving Russia. So yeah, what's that? I guess they grew 500,000 subscribers adjusted for that exit of Russia.
Yeah. And they did note that East and Central Europe were slowing as well as linked to that too. So we'll see how much that affects it for the next quarter as well. But still, they're predicting a large drop off next quarter. So it's not just a Q1 thing, apparently. And you mentioned that they're predicting revenue growth for next quarter. And they're talking about adding advertisements and also trying to restrict the ability to share accounts. I think I forget where they say it, but there's something like, yeah, here we go. In addition to our 222 million paying households, we estimate that Netflix is being shared with over 100 million additional households. And they're looking to find a way to tap into that. And that's obviously going to be there's going to be some friction there. But that could be, I wonder if that's where they're predicting they're getting some revenue growth, because it wouldn't be from new subscribers for next quarter.
Yeah, I question if that's actually a good strategy. I mean, for a business that's really grown pleasing customers, right? I mean, customers love the product. And, there must be something happening behind the scenes here where Netflix is maybe getting a little bit desperate to show increasing numbers if they're going to start doing this. So there could be a red flag.
Yeah,
in my opinion.
And they do mention right here, competition is fierce. It's only getting tougher. So they're feeling the pressure in some way, at least. If we're not just talking about, it's not a secular decline in the industry because it's not declining, but it's just that there's more competitors, and that's going to hurt.
Yeah.
Did they say why they're projecting
Super chat.
further decrease in subscribers?
Hold on, we interrupt your scheduled programming.
Oh, Jason interrupted me.
Jason is in the house. We'll have to ask you about this, Karan, if you'd be willing to indulge. You just did your update today, trimming process. That's
That
big
is a
here.
that is a hot new release on YouTube there.
I was shocked. I was like, "Whoa, big move!" So we'll have to get to that. Here's a teaser for you. We'll talk about that later if Karan is ready, willing, and able, just for Jason. But Brad, you were saying? Thank you.
Yeah. Did they give any guidance about why they're expecting subscribers to continue to decline? I mean, is it more kind of Russia fallout, or is there something else?
Yeah, if you scroll down in the letter, Jack, they basically said that we think there'll be a continuation of the current trends, essentially. But did
they give a specific reason? I don't remember seeing that.
Well, they gave 4 reasons why they think growth is slowing generally. They didn't really break it into this quarter versus next quarter, but that's the 4. There's things that influence the addressable market that are out of their control, basically, with adoption of internet connections. They've already got huge penetration in the US and Canada was kind of reason number 2, and probably more penetration than they maybe realized because of all the password sharing. And that's not a new phenomenon with Netflix, but they maybe just starting to realize how significant that is. A little bit on competition was reason number 3, and then macro was essentially reason number 4.
Yeah, the last one. Yeah. Sluggish economic growth, increasing inflation, geopolitical events, and continued disruption from the illness.
I think the somewhat forward pulled earnings from or subscriber growth during COVID, which some people that probably signed up that didn't really want it. So they're probably seeing this massive churn over the past 6 months and probably for a while ongoing yet. But that's not to say I'm not sold there won't be any growth in the future of subscribers for Netflix.
Sure.
But yeah, there's many reasons, like they said, but I think they should have touched more on the possible forward pull from COVID that kind of would have happened. And a lot of those just realizing they don't need it now that they're back at work and life is relatively normal again.
They do make a point of that in their letter. They say, like, we weren't really sure how much of this was forward pull, but clearly it played a factor. They did emphasize that a few times.
Mm-hmm. Yeah, I think a lot of the growth for Netflix is going to be international. If you go, I'm pretty sure it's in that letter again. Sorry, Jack. But if you scroll down, there's like subscribers by region and then also subscription price by region. And it should kind of smack people over their head that the US is several years ahead of, or US and Canada is several years ahead of many other regions. Yeah, if you look at like average revenue per membership, for example, in the US and Canada, and compare that to some of the other regions, there's pretty huge differences there. And I doubt some of those regions will ever get to where the US is. They'll probably both have prices move up. But I'd say there's more room to push prices in some of those other regions. But growing subscriber numbers in the first instance is probably the focus still.
Jack, is the income statement within that letter somewhere, or could you pull that up by any chance? I just wanted to point out how much churn there actually probably was, because they were saying they lost 200,000 subscribers or so. But their marketing spend, so I think was around 550 million from memory. I might just wait till you pull it up, so I'm not completely off on that.
Wait, say that again. What was 550 million?
Their marketing spend was around 550 or 500 or so. And if you assume that, say, it's $100 to acquire a customer with that marketing, then really they should have brought on 5 million or so new customers, which means the churn was closer to 5.2 million, if those numbers are correct, but I'm not sure on the exact marketing spend. Otherwise, if that wasn't the case, then the marketing spend was a complete waste of money.
Yeah, about 555.
555, yeah. And that's to really gain no operating income whatsoever. You can see that's relatively flat, I think up slightly year over year. And a decrease in earnings per share while doing that as well. So that's probably even more concerning than just saying 200,000 subscribers, as it's probably a much larger number, or the marketing spend was a huge waste.
Yeah, they touched on that a little bit in the letter. They think it's probably higher churn and I don't know exactly how to describe that. Sort of countries in and around the conflict.
Yeah.
But it's sometimes hard to narrow it down to any one thing, really. It's a bit of a complex ecosystem, really.
Yeah. Well, speaking of spending, we got to talk about the content churn. We talked about Netflix a while back when it dropped after their first quarter earnings, or I guess it was their Q4 earnings that were reported in January. It dropped there. That's when Bill Ackman bought in for the first time. We were talking about how to try to nail down how much of their spending that they do on content, something like $17 billion a year, how much of that was for maintaining current subscribers and how much of it was growth oriented. And that's pretty hard to say, at least in my humble opinion. And that dwarfs the marketing expense, or really any expense. I'll actually bring up Ticker. Here's I think they listed under
17 billion or so, I think.
Yeah, about 17 billion in 2021. I think trailing 12. Yeah, trailing 12 is about the same. It's actually growing still, almost at $18 billion in content spend. And that's a pretty big ramp up from just a couple of years ago where they were sitting closer to 11 or 12.
Yep.
That really is hard to kind of determine whether that's growth or maintenance. That's I guess any investment in Netflix is the bet on that, which I believe Ackman kind of talked about within his original purchase, not kind of specifically, but I think that was a big reasoning for anyone investing in Netflix, is to assume that most of this is growth CapEx rather than maintenance. But when you see a fall off in subscribers, you can probably say that maybe a lot of this $17 billion was not money well spent.
You know, that sounds like a hot take, but I don't think it's a hot take. Like, it's hard not to agree with that.
Well, I think it's probably a bit unfair picking on one quarter personally, but
true.
Time will tell on that. I think you're right. The entire kind of name of the game of making a investment in Netflix is really trying to determine, I guess, what Buffett might call owner earnings. So you can look at free cash flow, and that's been negative for Netflix for a long time, and debt's been growing and all that. It looks kind of like a terrible business when you just look at it through that lens. But
for sure,
I mean, there's, in my mind at least, pretty much zero doubt that at least some portion of that content spend is for growth, particularly outside of the US. It's really coming to a view on how much is for growth and how much is for just maintenance. I mean, if you take kind of that owner earnings view, the really bullish investors on Netflix will say that, you know, Netflix is hugely free cash flow generative, as Ackman might call it. They're just reinvesting all their free cash flow and also borrowing money to invest more to produce content for growth. But it's hard to determine. There is one way to get kind of a view on it. You can, and Hamish Hodder's done some good videos on this. You can compare it to competitors like Disney, look at what they're spending on content, and as a bit of a benchmark. You can also look at how they're amortizing content on their income statement. I guess like the movie and TV show equivalent of like depreciating a building in real estate. And if you look at the incentives around that, you could argue that Netflix management are incentivized to amortize that at quite a high rate, right? So they pay less tax essentially. So that's probably a way of taking a reasonably conservative view. I don't know. What do the rest of you guys think?
The competition that they're facing from the legacy content that Disney and HBO has, it's very difficult to compete with that. I think kind of reminds me of the whole Bruce Greenwald thing where, he's like, if you're investing in growth in an industry where there's a lot of competition, that's almost like destruction of value. So that's kind of what I'm seeing with Netflix.
You think it's the airlines of this century?
I think there's going to be a lot more consolidation in this space. Yeah, I do compare it to the airlines actually.
I'm curious with that content spend. It's tripled. I just noticed it tripled over the past 5 years. What has the subscriber count done over those 5 years? Does anyone know?
Let's see, Netflix subscriber count.
So it started in 2016. I'd be curious to see if it's tripled as well, or if the content spend's growing faster than.
So about 77 up to tripled.
Yeah, so it's about, which is reassuring, I guess, slightly.
Well, you could also look. You also have to look at how much subscriptions have increased over the last 5 years, right? Do you guys have a sense for that? I think there have been some increases.
As in price?
Prices, yeah. About every 2 years they raise prices. Is that right?
Well, I think they're raising prices constantly. It just varies by region and, that sort of thing. So it's hard to, I think there's a constant increase. It's just the regions jump around all over the place. So us down under might only see a price increase every 2 years or whatever, but, in the second year, the US again one or whatever.
Yeah. Now, I guess turning towards the more bullish scenario is, well, depends how you interpret this, I guess, that they are going to put advertising on Netflix. How that looks, I'm not exactly sure yet, but that could be a huge increase in earnings that haven't been seen. And they also mentioned the about having the passwords to kind of stop that problem of having multiple accounts being shared, which is a really large portion. I think it was Hamish Hodder that said, Tom, when you were on the podcast with him, that it was about 50% growth if they pulled on all those other people in just the US and Canada for people that are shared accounts. So there is a lot of growth that could come without actually increasing the overall subscribers, just by making people pay that are already using it in a sense.
There's a couple of ways to look at that. I mean, Netflix already have subscription tiers where you can have like simultaneous viewing by 2 user profiles or whatever. So I think if they were to hypothetically find a way to crack down on password sharing, I think that potentially cannibalize some of that revenue. Like people would drop a subscription tier because they no longer need just like to be able to watch through 2 profiles at the same time. I think that's how they've kind of worked around the password sharing in the past. If they've just put in that tier that kicks people up to a slightly higher price. So sure, they're not capturing the same amount of revenue as if they had 2 completely separate accounts, but they're capturing some of it.
And then how are you thinking about advertising and how that looks and whether that's a good or bad thing?
Well, personally, I'm concerned, if they offer this free tier with ads, is that going to cannibalize the paid side?
Yeah.
Right?
Yeah. Same.
It sounds a lot more like YouTube at that point. Just saying.
Yeah, except they have to pay for the content and Google doesn't.
Yeah, right.
Exactly, yeah.
Yeah.
I know I would probably stop paying for Netflix if there was a free version with ads available.
Yep.
And I think it would be a huge majority, but it's which model looks better at the end. Is the ads model, free ads model, more profitable?
Right. How solidly can they monetize the ads, right?
Like obviously YouTube's made it work, so there's no reason to say Netflix can't do something very similar to YouTube's model.
Google has their search engine. That's kind of the core business. So that's something Netflix can't replicate as well. So.
And they also have the fact that they pay their creators to put content on there at YouTube, whereas Netflix, I guess in a sense, are doing that, but they're not. I guess people that are developing films and TV shows aren't necessarily limited to just Netflix. So, whereas YouTube creators are dedicated to one platform.
Another thought I had, if they're reliant on ads, that also makes them more susceptible to these fluctuations in the economy, right? If advertisers, are going to pull back spend when things are rough, it's really going to impact Netflix as well, much more so than it does now.
I was going to say something similar, like how the subscription model is very predictable in comparison to ads, I would imagine. So yeah, but I've probably heard on the upside as well. In a boom time where ad spend is going like crazy, you'd make more, but in a downtime you'd make less, I would think.
Yeah, it's probably worth noting here that I mean they're kind of just talking about this free tier with ads at the moment. They're talking 1 to 2 years away if they do go ahead with it. And Reed Hastings said on the conference call that he's really never been a fan of this idea of having a free tier with ads at all. He just thinks the subscription pricing model is a much simpler way to go. But I think he kind of followed that up by saying he's a bigger he's a bigger fan of consumers having more choice. So he's a bit torn on this issue.
Sort of mostly on topic. Alexander here says it takes a while to ramp up an ad platform. YouTube had years of experience analyzing user data and targeting ads accordingly. Well, I mean, it's not like Netflix doesn't have any data at this point. You wonder how much they've collected that's accurate, especially if multiple people are using it. I don't know how much demographic data they have.
To be fair, Reed Hastings kind of said the same comment, actually.
Oh, did he?
Kind of beating Netflix down a little. Yeah. He said we haven't got into that fancy advertising and tracking stuff yet or something along those lines.
Their only valuable data is, I guess, what type of show you like to watch. So their algorithm works in that sense where you get recommended these new shows. So maybe their advertising model is similar to what you see at the cinemas, I guess, for other movies or upcoming series. I don't know. I don't know how that would look, but it would definitely be interesting.
That would be that makes me think of like Amazon's ad model where you're a seller on the platform and you advertise it. I get Netflix makes their own material, but if they bring on more like third-party producers or something, you can advertise your movie there. More akin to like an Amazon or I guess sort of like a YouTube as well, where you're actually running ads to the movie within the platform. That could be something. It just becomes YouTube for movies. That would be something.
Are any of you intrigued by the current price? Thinking about dipping a toe in?
I'm thinking there's more to get comfortable with, but I'm certainly not rolling it out.
I took a quick look today. I'll be doing a video on it for Monday. And I struggle right now because a lot needs to go right and from current prices. At least if you're looking at it from a free cash flow perspective, you could still make money on it, of course, because you never know what the stock's going to do. But not for me yet, though. It's definitely interesting.
How likely do you think it is for Netflix to get acquired or merge with someone? Maybe say 2-3 years out.
I think they're too big.
Yeah,
I don't think it would get approved by any of these larger companies wanting to buy out Netflix.
It's sub 100 billion now. It's 90 something,
which is pretty crazy, to be honest.
Elon could do it.
Funding just secured.
Yeah. Yeah, I think it's way too big.
Would be a Google or a Amazon, something like that. But
do they merge with Disney?
Pretty unlikely.
I would see Netflix buying someone else before.
I could see a Disney thing.
Oh, could you imagine? Disney just owns like 90% of the world's content.
I don't think that would float very well with SAC either. That'd be pretty monopoly.
Antitrust would I think get pretty.
No, maybe like a spin-off of their Disney Plus or something.
Yeah,
that sort of arrangement, similar to what happened with AT&T, HBO, Discovery, whole merger thing, like further consolidation.
It's a possibility.
If one of them crashes and burns, I think that becomes more possible.
I think Netflix might crash and burn.
I would think, I would if I had to guess, if one were to crash and burn, which would be first? I would assume Netflix, just because of all the legacy content that always will provide kind of a backbone for Disney. Not that it's likely
could
that
get
either
to a 60 billion valuation, I think.
Yeah.
I don't know what I would pick there. I don't see any of them crashing and burning. I could see growth leveling out and it becomes kind of this slow growth.
The airlines.
I don't know. I don't see anything that dramatic happening.
Yeah, me neither.
I think Netflix are far more in control of themselves not crashing and burning now that they make their own content. I mean, they're kind of becoming more and more like a film studio and TV production studio, right? They used to just purely license content off Disney and a bunch of other companies, and
all the companies that now have their own.
Yeah, they can make the content, but will people watch? That's a big question mark.
I think the kind of a broader, I guess it's a macro kind of consideration, is there's just so many subscription services, even outside of streaming, that people are just paying for. And now it kind of gets to the point, particularly in an environment like we're in today, where you have to pick and choose which ones you keep.
Yeah.
Do you keep Spotify before you keep Netflix? Whatever you're paying for. I think I have 3 or 4 different things, and I know people that have well and truly more than that. So I think that's the broader issue that a lot of these software or subscription as a service type business will struggle from, as people have to become more picky with which ones they keep.
Yeah, I don't have the information in front of me, but I think that is a good point, particularly as they all presumably at some point will start ramping prices when they run into the Netflix issue and can't grow subscriber numbers as quickly anymore. Don't have the data in front of me, but Netflix often refer to Nielsen, which I think is just some sort of like
it's a survey company,
industry analytics, survey type
Marketing
thing. And Netflix seem to be like pretty consistently having like the highest satisfaction and watch time and all that sort of thing. So it seems like that'd be one of the last ones to get cancelled, but
it's because they're one of the first ones to get in to the subscription.
But even now, like that, they're so well, ingrained in the
that's what I mean.
Particularly, they've still got really high retention.
It's because people have had it for dare I call it like a Costco. People, you're a member for forever. Like it's very sticky membership, and some people have had Netflix for a decade. It's just a very long time at this point.
Could you see him going down maybe the live route? Thinking about things like live sports or something like that to kind of boost their services they provide. I think
Apple and Amazon are trying to do some of that. At least I have my MLB perspective for baseball here in the States, and they're partnering on certain broadcasts, Apple TV and whatever Amazon streaming is called. I haven't seen anything with Netflix doing something like that. So I wonder if
Disney do something with their ESPN.
Yeah, they already own ESPN Plus. Yeah. So, but as for Amazon and Apple, this is kind of a new move.
Yeah, I think Netflix. As they've demonstrated, they're going down the like Drive to Survive kind of route, doing more of that sports documentary type stuff. Like that's Drive to Survive has been super successful for getting people into Formula One again.
And then why not add on to that the live Grand Prix on Netflix? Tune in live, pay $10.
I'd imagine that's probably a really hard game to break into because there's probably huge like TV contracts that take forever to expire. Like I know I think Fox just signed the rights for the Super Bowl a couple of years ago for like a 10-year contract. So these things don't run out quickly. I don't know how easy they are to break, but it seems like a pretty niche and hard to break into thing because they're all protected in some way. Though, not that it's not possible. It's just I think it's kind of a different game, for lack of a better word.
I think we will see Netflix. I think they almost have to transition in some way if they want to continue the growth they have in the past. Maybe they don't want to. Maybe they're happy to slow down their growth and become a more mature company. But I guess I would have some confidence in management's ability to do that since they transitioned from sending DVDs in the mail to what they are today. So I think there's a lot of optionality of what they could become. But how that looks is just pretty hard to know. And how profitable that could be is well and truly out of the realm of question, I think.
But that's where they're getting into gaming, right?
What was that?
That's where they're getting into gaming.
See, that's another interesting route that I could see. Like, is that like the idea of competing with a Twitch, or how is that meant to look? Does anyone know?
I have no idea.
Well, at the moment, they have those terrible little widgets in the Netflix app. I'm not sure if you've seen that.
No, elaborate.
I'd have to check, but it's hang on, I'm gonna open Netflix on my phone. They've got these like horrendous little like you play solitaire inside Netflix type games.
Does it show an ad?
What's that? Does it show
Does
an
it
ad?
show an ad or something, or
No, it's just like part of
Just-
Netflix now.
just to keep you on the app? I guess.
Yeah, Netflix games, no adverts, extra fees, or in-app purchases. Unlimited access to exclusive games included in your membership.
Wait, so
I can
no
play.
in-app purchases. None.
I can play Trivia Quest, Card Blast, Stranger Things 3, the game. I got Temp Bowling. I got Dominoes.
Oh, they got to have like loot boxes coming then. They're like just going the full mobile gaming route.
something
Oh,
called
shit.
something called Kittens. I don't know what that.
I had no idea that was a thing.
Unless they advertise something like that, I would really question the capital being put towards that, since there's no way that brings on a new subscriber just so they can come and play
No, but that would be
Whatever.
your like the
Stranger
1%,
Things 3.
the 1% who like take their mom's credit card and then you use it to buy like boosters on the game that drive some extra revenue per user or something. that would be I did not know that was potentially on the horizon for Netflix.
Yeah, is that one of those things that they just roll out in New Zealand and Australia first? Maybe
Could be. Are you the test
for
market?
for some reason that's a thing. They just keep picking New Zealand. Like we got Pokemon Go first back in the day.
It's
that
because
came
it's
to
like
New Zealand.
it's English speaking small. Like is that it? Like we'll
we're a
try it here.
little beta testing group.
You guys are the early adopters. You're leading edge here.
Maybe.
You're like far enough away from US and Canada that you won't like disturb anyone. Is it something like that?
Yeah, occasionally get left off world maps.
I mean, like 99% of Americans wouldn't be able to find New Zealand anyways on a map.
Yeah, that'd point to Australia maybe.
Yeah, nah. They'd probably point to like maybe Madagascar.
Tasmania,
They know it's an
probably.
island. Tasmania.
Yeah.
Yeah, so I'm equally skeptical on gaming, Frank.
I love that that's a thing, though. I had no idea.
Well,
Yeah,
I
they've
think,
been doing a few little acquisitions.
I don't know if they'd even be trying to go the Twitch route. Maybe it's more actual games, not game streaming. But I think Twitch is still a cash burn for Amazon. I think they've been burning a lot of cash for a long time. So I wouldn't imagine that would be a great thing for Netflix anytime soon.
Yeah, probably not. I do wonder, like, what I think a big question, like we were saying earlier, is how much drop off would you have from paying subscribers who would say, "Hey, I'd rather do this free with ads model." I'm sure they'll do surveys in the coming months if that's something they're considering.
And they would trial it through regions and stuff too.
Yeah,
to see what
New Zealand.
to kind of see how that looked, I guess. Like, I know you might lose half your subscribers, but the ad revenue might more than make up for that. So, but yeah, I think that's a hard model to push. I don't know how that would look, particularly like we said, without having that data to really.
It's hard to unwind because they're already so used to the subscription model, and I think their people are too. Their subscribers. Should we talk about our man Bill Ackman? Paper hands. Everyone's a day trader now, I swear, in the value space. Because Bill Ackman sold Netflix, as you probably have all seen by now, but if you haven't, here's the news. He announced just a couple days ago that right after these earnings, he and Pershing Square sold off their Netflix stake, which they just bought back at the end of January. So less than a quarter they own Netflix. And I think it was like $1 or $1.1 billion they invested. And they sold that for like a $400 million loss. So pretty significant loss, all things considered. And in this letter, Ackman says that in light of the enormous operating leverage inherent in the company's business model, changes in the company's future subscriber growth can have an outsized impact on the estimate of the intrinsic value. So they really did not like to see, no investor would like to see subscribers shrinking at all, as they're probably factoring in some pretty major growth. But this we were talking about it beforehand when Bill Ackman first made this move. we're talking about how predictable is Netflix really. That's obviously a big part of Ackman's thesis in a lot of his investments is the predictable free cash flows, predictability, and lower uncertainty. But then he gets into Netflix, which has only had like one positive free cash flow year in the last 5, and had just hit negative free cash flow again, which is very not unlike what you might see in a lot of his other holdings. And sure enough, he's out just a few months later. What was your guys' reaction to this?
Very hypocritical. I don't know if that's the right word, but he made it seem like it was such an easy, no-brainer investment, and now it's suddenly in the too hard pile. 2 months
funny you
later,
say that.
like,
I have his original one.
It's absolutely insane.
This is just a few months ago in January.
Can you zoom in a little bit on that?
Yeah,
Jack?
sorry. Highly recurring revenues, enormous future growth, economies of scale. Okay, this is the part that I did that. Because also here, I'm flipping back to the other letter now. Netflix announced that it would modify its subscription-only model to be more aggressive in going after non-paying customers, like we were just talking about. Advertising maybe something to get the non-paying folks in and get some revenue that way. And he says, we believe these changes are sensible, but it's extremely difficult to predict their impact on the company's long-term subscriber growth. So he makes it sound like it's a bad thing. Yet over here, he's talking about how they have so much pricing power. So it's like, whoa, wait, hold on a second. You think he would have expected something like this if this was a big selling point or a buying point, I guess.
And then he said that he required a lot of predictability, but back then he just said how much recurring revenues they had.
Right.
So I don't know. It's as much as I want to say it's a good thing. The thesis changed in his mind, so he exited. He made it public. He was happy to disclose it. Like that's all well and good, but it's very quick time to change your opinion that fast and kind of just backtrack on everything you said 2 months ago or however long ago it was.
To me, the sale makes more sense than the buy. I know we have hindsight now, but the buy didn't seem to fit what his usual model is, even though he's saying all these great things in here. Just given no one really knows how much is maintenance spend, how much is growth spend. And he's acting like, oh, it's so great and predictable. And then 3 months later, he's like, yeah, it's not that predictable. So it's okay. I guess a lot changed in 3 months.
So I guess the variation is only 1 to 2%. So if that changes your overall thesis, that's pretty concerning. Like if 1 or 2% subscriber decline, or it's probably not even that much, it's probably lower. If that changes your thesis in such a short time, that's concerning of what your conviction was like 2 months ago when you were willing to make such a large bet.
Yeah, $1 billion. That was a big chunk of the fund.
But yeah, I guess I said the other side where it's like the thesis changed. He doesn't want to be anymore. So he exited and he was public and owned up to it. So I don't know where I sit on that.
And public as he always is.
Yeah.
Any other thoughts on Bill Ackman's sale? Lessons to learn?
Well, I mean, I don't know. Okay, Karen.
Oh, go for it, Tom.
I was just going to say it's interesting that he kind of references that he's kind of made the mistake of maybe hanging on to something too long in the past, and he's trying to avoid doing that this time. I don't really know what that's in reference to, but interesting observation.
He's had some big losers, so he has plenty of big winners, a number of big losers too. It's kind of hit or miss. Yeah,
and with I mean, his big Herbalife short was a multi-year, long dragged out thing, right? So
that was like a personal thing.
Yeah, but maybe he's trying to minimize that return on brain damage by just getting it over and done with and moving on.
I think this Netflix loss is even bigger than we know because the way he got into the Netflix position was by selling off the hedge that he had against interest rates. So that would have done actually really well because
big opportunity cost right there. Yeah,
we've seen how treasuries have been over the past month. Like it's been a fantastic place to short. So
I forget
he would have actually done way better in that.
Did he sell the whole hedge? I thought he sold most of it, or was it the whole?
He sold most of it. Then he bought Netflix. Then again he entered the hedge, and I think that's why the fund kind of went up in the last 2 months or so.
Yeah, it's flat on the year, I think, despite losing $400 million right here.
It's the hedge that's kind of compensating for the loss. So
Waiting for him to go on TV again and talk about interest rates going. To,
Please don't. No, Bill. Didn't he say he was going to stop doing that?
He said that, and then I swear, like
super chat.
He's
You
back
guys,
at it again.
Jason upped his game. Look at this.
Jason, what's our attention?
He was
Jason,
in there
I
causing
noticed in the chat you're drumming up some non-existent beef here that
causing a ruckus in the chat.
that we've ousted you or something. I know
someone even said that he was going to get banned, and then he donates money to make sure he doesn't get banned.
Yeah, let's see, where is he? Say you don't like Meta and don't want to make it a 20% position, and they kick you off the show. He wants our respect. Oh, that Jackson.
He even made a comment. He said, "They run the show and I run the comments."
Oh boy.
It's not a bad take, actually.
Closest
Well,
friend of the
he
show.
keeps throwing dollars at us. So
He does.
Guys, do you know what Terry Smith said about Ackman? Someone made a comment. Maybe Terry Smith was right.
Oh yeah,
about
I
Ackman.
remember. Yeah, he said he was talking about activist investors and how he's been involved with a number of them over the years, and Bill Ackman is one of the worst he's ever experienced.
By that, like just abrasive or
yeah,
stubborn?
just ruthless. Not. I don't know how to describe it. He just did not look favorably on Bill Ackman, based on his previous experience with Bill shorting one of the companies in the Fundsmith portfolio.
I actually, to the activist part, I forget where I heard it, but there was some speculation that maybe there was something that he was expecting Netflix to do, and they didn't do it. Some sort of activist suggestion he might have had, and they didn't want to do it. Maybe there's something there that would explain part of the quick exit.
I think he was expecting more buybacks, which they completely paused.
Yeah.
Yeah. And so much for criticized by category from Terry Smith. Should we take some questions, or have we got more to say on Netflix, or what are we doing?
Yeah, I think Ackman should stick to like the chain restaurants. That's worked out well.
Yeah, that was my conclusion as
Domino's,
well.
Chipotle.
I think he might be interested in McDonald's, right now, because someone else is also interested in McDonald's right now. So
yeah, that's right. Good old Carl.
Shockingly bad. That's right. That's what Terry Smith
Thank
said.
you, Sven. Here's the quote.
Nailed it, Sven. ADP was the company.
Jack, one of these days you should give us a Bill Ackman impression.
I don't know if I could do it that well. I'd have to practice.
I think you could either do the. I think you got probably three options. You could do the Carl Icahn conference call. You could do the crying on CNBC, or you could do. I reckon a really good one would just be like rattling off his checklist, where he's like, "We look for
predictable free cash flows,
free cash flow generative something."
I guess my voice isn't too far off, but I'd have to practice. Yeah. It's not quite right. His speaking pattern is kind of weird.
You could need a wig as well.
Yeah. I have the dark eyebrows.
Fox look,
I have the dark eyebrows. That could work. But yeah, I would need the light hair.
I feel like you need like a blue steel kind of lipstick as well. Bill has that kind
of. You're kind of right about that. I'll have to practice.
Okay.
Then I'll rattle off his checklist whenever we bring him up on the show.
It's only like 6 or 7.
Art of Value says only clone Ackman when he cries on CNBC. That's not a bad idea. Actually, you want to do the opposite when he cries. If he's saying sell, then
right.
Buy.
Do what he's doing when he's crying, which is actually the opposite.
Follow him when he's crying. Cry with him.
Poor Bill.
All right, let's had a lively chat here. I mean, Jason got them all riled up, so we got some good stuff in here. I'm going back to the beginning. Let me get some of these earlier questions.
Has anyone looked at Salesforce out of curiosity? We've had that come up a number of times.
we got to mention Carvana and then Process as well, real quick.
We do.
Oh, of course.
Carvana also free fell on earnings.
Haven't looked at Salesforce closely, but
how much is Salesforce down? Is this one of these stocks that have been hit hard? It's not one I've paid attention to at all.
It got hit hard a while ago. I don't know what it's done recently.
I've got a
nearly down half.
I've got a general question here. This would go to how you value any company right now, but Lily says, I really enjoy y'all's content. Thank you. I wanted to get y'all's opinion on evaluation methods when using risk-free rates, 10-year treasury bonds. How do you all go about valuing companies when there are rising rates? So that's the environment we're in. Interest rates are rising. There's a lot of concern with that. Does that change the equation? Maybe I would think my knee-jerk answer would be maybe you raise your discount rates, get a little more conservative maybe in your valuations. Granted, you always want to be a little conservative. That'd probably be the only thing that would change for me is I might just bump up my discount rate a little bit if I'm uncertain about something.
Yeah, and I don't know if any of us really even use 10-year treasury bonds as like a risk-free rate and as like a reference point in a DCF or something. I mean, I tend to just discount cash flows at the same rate for all businesses, which
same here.
MBAs would scoff at, but I think it's just a simple way of doing it personally. And I guess I try not to move the goalpost too much with discount rates. It's just kind of a consistent reference point, and you buy what's most attractive.
Well, really, I look at because I have debt, I look at that as kind of my risk-free rate. Like, oh, I have this debt over here I could pay off. So I definitely want to get better than that. That's kind of how I look at it. So if that's fixed or variable rate, that'll change the equation. But I don't, like you, Tom, I don't really look at for my own investments what the risk-free rate is.
Karan, do you ever run a discounted cash flow? I don't know if I've ever heard you talk about it. Or you just, if it doesn't hit you over the head, you don't even worry about it?
Yeah, so like back in university, that time like we used to build financial models and stuff. Like we had a course on that and everything. But it's been a while since I've done all that. Yeah, so kind of wait for like opportunities that are really no-brainers and then go in for those.
Nice.
I'm starting to move. Oh, sorry. Go ahead.
I was just going to ask, Karan, do you look more at like some of the parts or maybe current free cash flow yield? I'm sure there's some metrics that you pay attention to. You're not necessarily putting it into a big old model because you don't really need to do that. But is that kind of your approach?
Depends on the company. Mostly I try to actually go through and learn about the business itself. If the business makes sense to me, like for example, when I was going through Process, I was looking at how Koos Becker was thinking about stuff. So I'd actually go through old talks, lectures that he's given, and how he was allocating capital, why he was making the decision that he was making. And then based off that, kind of build up a framework of what I think about the company, and then I go into Process. So that's kind of what I prefer to do now. If I understand it, great. If I don't, pass. Like Netflix, complete pass. Like I could look at any metric that's appealing, but I see so much competition that I'm like, yeah, doesn't make sense.
Yeah.
At any price. Yeah.
Makes sense. Frank, you were going to say?
Yeah, I just think the further I've gone into investing and developed my kind of understanding and how I analyze businesses, the less I rely on a discounted cash flow. I think earlier in investing, I used to do a lot of discounted cash flows, and usually I'll do it now, sometimes just as content or sometimes just to kind of like double check the numbers. But I really like a more back of the envelope type approach where if I can't make it make sense in my head really quickly, then it probably doesn't make sense, regardless of how I put it into the discounted cash flow, adjust the multiple, adjust the discount rate to try and make it something I like. And back of the envelope doesn't necessarily mean it fits on the back of an envelope, but just keep it as simple as possible and see what it looks like.
So you're telling me you don't have a stack of envelopes on your desk to write on the back of?
Maybe that would be good content. Maybe I should get some envelopes.
There's this guy. He's like an Instagram account. It's called Real Estate Old School, and he's like this investor who's bought a bunch of properties over the last few decades, and he's just kind of gives real estate wisdom. And one thing he says, and it's always stuck with me, is numbers don't lie, but liars can number. So you just got to keep that in mind when you're approaching any analysis. You can always fudge the numbers to fit whatever bias you might have. So you got to be really careful that you don't. If it doesn't work the first time, that's a big red flag. So don't try to erase the red flag and pretend like it's not there. You just always got to be careful with that.
Well, yeah, and the more complex your DCF model is, right, the more inputs. I mean, you can just torture the numbers until you get the output that you want, basically.
Right.
So you got to be careful.
Have you guys gone
it can
through,
give
like,
you
sorry.
I was just going to say it can give you a false sense of precision. So there's really no point opening Excel or whatever until, like Karan was talking about, you understand the business very well.
I like using it as just sort of okay, what really needs to happen for this to work? It's not so much this will happen. It's like what is even possible, and then could this happen? That's what I try to use it for. And if it's just like so ridiculous, like they need to grow cash flows like in some absurd way, like we did our Tesla analysis on April Fool's Day. Like it's just kind of getting a range of possibilities is how I like to look at it. Especially if something
proof analysis, by the way.
Yeah, right. Yeah, that one was, locking it down. But I think it's good for kind of getting your like a relative feel for what really needs to happen for this valuation to really make sense. And sometimes it's that not a lot needs to happen, in which case you probably have a great deal. But in many cases, a lot does need to happen, and that I might steer clear unless I really understand something that many others might not.
I think the simplest way I really think of it kind of goes with the Davis double, the Shelby Davis method, which three things really drive any returns in the stock market. And it's earnings growth, dividend yield, less so dividend yield, and multiple expansion. So if you look at a company, you assess those three things. If you think it can grow at 10%, it pays a 5% dividend yield, and there's going to be no multiple expansion, then you have a 15% annual return. And that's obviously very back of the envelope, like I said, but if you get a good starting point like that, that can tell you whether or not it's on the right track. And maybe then you run a discounted cash flow or some of the parts valuation, depending on the type of business. But I don't think you want to rely on anything complex.
I like it.
Have you guys seen Aswa Damodaran's, whole massive Excel sheets? That
Sure. It's like 10 tabs, isn't it?
Yeah. So I actually went through, like, he has a course, right? He puts it up, whatever, for each semester. I went through one of those entirely on YouTube, and it's free. Anyone can do that. And it's interesting. You do learn something. But like the way he prices it, it's like you have the country risk premium, you have so on. So you have so many moving parts, and eventually, like you get this false sense of precision. Like, yes, I get this company, even if you're completely off. But it's not that DCF isn't useful. It is when you're building out the story. It is useful, but then it shouldn't be the only thing that you're relying on. At least that's my thought on it.
Yeah, it's like if you do one of those models on a horse and cart company, you should probably see if cars are around the corner, basically, right?
Exactly. Yeah. Like he's done one for Saudi Aramco. It's on YouTube. It's interesting. But again, that would really require you to be speculating on what you think the price of oil would be. Like, it's a huge, there's a lot of other stuff to it. Yeah.
Should we talk about, we got to talk about Prosus a little bit, and then Carvana. I just want to take a look at Carvana. I know that's there's a loyal following of Carvana in this punch card group. So
a lot of used car enthusiast.
used car enthusiast.
If
Indeed.
you own Carvana, let us know in the chat. I'm curious how many we have here right now.
If you've made money or lost money,
No, we'll leave that. That'll be
Unlikely.
this follow-up question.
Yeah, down 64% year to date. Crazy. And they had another bad earnings recently. I haven't looked too closely at the numbers. I just heard the bad news. Oof, still incinerating cash.
You
2.6
guys think
billion.
Cliff's in the chat?
Yeah. This one, I just on the surface, I don't really understand it. What the real appeal is here, other than they're going to grow out of this. But man, they got a mountain to climb. At least this is what it looks like.
Well, I think the pitch is, a lot of things have moved online in terms of, selling, buying. Cars largely have not. Right, it's still a very untapped frontier, and Carvana aims to be kind of the dominant platform for online used car sales. So that's what they're working towards. Obviously, it's hard to predict how likely they are to achieve that. It's not an easy task.
No. I've heard I know in our Discord, I think a lazy investor, he's always active in the in the Discord, and some others have
Speak of the
talked.
devil.
Is he here?
Hey.
I was towards. Yeah, there he is. Oh, just because I mentioned you, I'll bring you up. Carvana's a burning brown bag left on the porch. Don't ask what's in the bag.
We won't ask what's in the bag.
I know he's brought up a lot of the legal issues they're facing. With I guess there's some problems they're facing with car title. I guess there's some problems when you sell a car where you can't show proper title, obviously. And a lot of states have big problems with that. Lenders would have problems with that. So I guess that's a hurdle they're facing. I don't know how big the problem is, but it's something that apparently is a problem.
Sounds like one of the things Carvana is doing is they're trying to work with the DMVs in every different strait to kind of streamline this car sale process.
Yeah, good luck with that.
That sounds like a nightmare.
Good luck with that.
Oh my gosh.
See,
But if they can do it, that is a huge.
I agree, but that's like more than a coin flip. That's a long shot. I concur with Jeremy here. If Carvana couldn't turn a profit in 2021, profit's a long way off. Just one of the most outrageous bullish years for used cars.
Well,
I get there in growth. I get there in growth mode.
This is kind of a long-term ramp up, right? They have to spend a lot of money to build out the infrastructure to have this dominant platform. But yeah,
like you can picture they could reach that dominance, huge profits, but like I said, there's a lot to get through.
Yeah.
And it doesn't seem to be getting better, unless I'm mistaken about that.
I don't know.
All right.
Should we just retire talking about Carvana for like future episodes?
No, next quarter when it goes down again, then we can bring it back up.
You don't like talking about Carvana, Karan?
Yeah, their prices are going lower than. Well, no, actually, the stock is going lower than their prices. I don't know. There's something in there.
I picked it up, Karan.
Yeah.
The sentiment was there.
Is Carvana? I'm guessing they're not in UAE or New Zealand.
No.
Probably just US at this point.
No, we didn't get the beta test job on that one.
Oh, bummer.
Shall we talk about, speaking of selling, something?
Karan.
Selling.
We got a bone to pick. This is in the punch card portfolio, Karan. You've betrayed us.
Well, it's a 20% position. Like that's betrayal.
So to clarify, you still own
a
significant portion, but you're trimming.
Yeah, it's like 20% of my portfolio. It's I think it's pretty significant.
Sounds
Karan's a top 10 shareholder.
It's
Yeah,
an
at the
activist
rate that
type
they're falling,
profile.
I might just become one. Yeah. They've like crashed. They've crashed how much? Like 60-70% since Feb last year. So
Is it because you want to allocate towards something else, or just want cash, or
Yeah, give us the high level pitch, Karan.
what's the reasoning for just the trim?
well, two main reasons. One being obviously I don't think that I think the capital allocation skill might have been hindered because of possible sanctions that might come up. They invest in emerging markets largely, and we're seeing a lot of regulations come up everywhere. So that's one thought. Second thought is I'm trying to reduce my portfolio in order to have like everything at a 10% cost basis. So this is largely like driven by, again, the kind of talk that Tom had with Guy about the psychology of the investors. And it's something I haven't really appreciated as much. And I feel like I'm going to stick to that, having a 10 by 10 portfolio. And I kind of want to level off my portfolio also. So two reasons over there.
So going for that more balanced portfolio.
Yeah, like max 8 positions, 8 to 9 rather than like 3. So
Very Ackman style portfolio
well,
without all the shorting.
yeah.
Without the tears.
You talked about how you. So what? You have 10% to Pershing Square Tontine Holdings, 10% towards one of the Chamath SPACs, 10%. You build your portfolio of SPACs.
That's a well balanced
IP
portfolio.
I think Karan's got that lined
No,
up.
yeah, just do like 6 of them, and then you're already up to 70%, and then you got 3 more holdings. One can be processed, and there you got a really balanced, great portfolio.
Well diversified.
Very diversified, better than cash.
So have you already reallocated that to some other position, Karan, or you're just
So I've been buying
hanging on to
KWeb,
cash?
which is the Chinese Internet Giants ETF. So again, like still optimistic on. It's not that there can't be sanctions on China. I get that, but the likelihood that the sanctions will be as bad as Russia Ukraine, I don't think so. Like I'm optimistic on the fundamentals of the underlying businesses. So when you just go through that list, you see companies like Xiaomi, you see companies like obviously Alibaba, Tencent, VIP, Shop. All these companies have started buying back shares and doing it quite aggressively. They have very little debt. China's also kind of, again, like I know we don't focus on macro too much, but China's got a different monetary cycle going on where they're cutting rates rather than raising them. So these are all tailwinds, and I think it's a good time to be invested in China. So
more of a basket bet.
So it's still, so it's still a very China heavy allocation, those dollars that were in process. You haven't gone and bought Nikola on us or something.
Yeah. I think I'm like almost probably 60% China down.
Wow.
Yeah.
Wow. It's like Owen Wilson.
Wow. Yeah, we did say it like that. Wow. Do you want to trim that down at all from the 60%, or are you comfortable with that?
No, I'll probably add to KWeb more
so going beyond the 60% then is what you're thinking.
Yeah, 60, 65 around that range.
All right.
Okay with that.
So China to Karan is like Turkey to Pabrai, huh?
You mean to you, Brad? I know you're there every week. You're there every week.
Jason talked me into it.
Is Jason on the board too?
That might just be like Ackman, and in 2 months change my mind. So
right, that could be.
Yeah. We'll check back when you release your new shareholder letter.
I heard a rumor that Brad Kellner is actually an alias, and you were the insider buying races a few weeks back. under a different name.
His real name is actually Stock Compounder.
Okay. No, I didn't say that on the filing, I don't think.
I have nothing to add on that.
Okay.
Tom, a week from now, are you going to be on a plane?
What's today?
Well, did you
Saturday.
say you're leaving Wednesday or Thursday or whatever day that is for you?
No, we still have Wednesday, don't we?
Yeah,
No,
that's not what it meant. Jeez.
I'm on a plane on Tuesday, so I'm going to Sydney first, and then I'm flying Auckland to Sydney. I'm meeting up with Brandon and Hamish in Sydney, and then we fly out early the Wednesday morning to fly to LAX, which is like a almost 14-hour flight, I think.
That jet lag's that's gonna wallop you.
Yeah, we leave at like 10 a.m. on Wednesday, and then I don't know, somehow arrive earlier than that on Wednesday, 13 hours later in the US. We have a big layover at LAX, and then we fly 3 hours or whatever it is to Omaha after that. So I think we'll get to Omaha on Wednesday evening.
Epic. Are you going to do a bunch of live streaming, Periscope? I don't know what all the apps are, but that'd be fun.
Yeah, I'm not sure. I guess I was thinking of putting a poll up. I'm not sure what the people want to see.
If it's hard to do long form stuff, you can get some like decent shorts, maybe.
Totally.
It's like little clips here and there, meeting people. That could be pretty cool.
Mm-hmm. Yep. Yeah, and I'm slowly filling the weekend with different events, which would be quite cool. I've already had a few messages on Twitter from people that are also going to be there that I didn't realize they were coming. So it'd be cool to meet some people I've spoken to on there, and it'll be cool to kind of travel with Brandon and Hamish. I've never met them in person before, so we'll find out if we like each other or not after 2 weeks, I suppose, of traveling together.
It's weird meeting people who you've only known like through video. It's super bizarre. I just met a bunch of folks yesterday at like a event through like a real estate club from my law school, and there's a bunch of people I met last year only online, and I meet them in person, and it's weird seeing like, oh, you're like a foot taller than me, you're a foot shorter than me. Like it's super unsettling. You have no idea.
Yeah. Right, we're all just heads here.
Yeah. We shall meet at some point, maybe for the Dubai conference or something. The Dubai
the Cayman Islands. I feel like we should meet in the Cayman Islands.
Right. Caymans is where our eventual fund will be, of course. So that makes sense.
Karan can skip of the boat.
Yes.
Cruising around the Caymans.
Karan will bring the boat.
Yeah. Tom's got the fishing rods ready.
Yep, for sure.
Are you going to ask Buffett a question, Tom? You got anything lined up?
Nothing lined up.
Okay.
What would your question be? I guess that's 21 too. If you did get to ask Buffett something, one question.
I don't know, honestly. I mean, we sort of pretend to know what's going through Buffett's head every time he makes an investment. So I don't know if we've got anything we need to figure out from you. I've thought about this. I honestly have no clue what I would ask him. Like, I don't think there's anything investment related. I really still have like a burning question on for Buffett.
He's answered so many investing questions. It'd have to be something kind of weird.
Maybe I'd ask him about his farm that he bought back in the day.
Yeah.
What kind of crops is he growing? I don't know. Can I go take a tour? Yeah.
I'd imagine he'd love to get a question like that just to spice it up. You feel like get so many of the same questions over and over.
Yeah, it's probably like 0.00001% of his net worth, but I bet you he'd like know last year's crop yields exactly. He seems like that kind of guy.
Yeah.
Yeah. That'd be a fun question.
I think I would ask him about nets as kind of a selfish interest of mine, whether he thinks like these liquidation value Ben Graham investments could still work. There are investors out there doing it and it's working for them, but I'd love to know what Buffett thinks of a Ben Graham net investment in 2022.
Well, SRG too. Does Buffett still own Seritage, right?
Yeah, forgot about
What-
that one. I
what
don't
does he
think
think
he'd
about
tell
it?
us the answer, would he?
Come on,
Probably
bro.
He'd probably be
Ask
like,
him about
"What is
SRG."
The obvious one, right?
Okay. Jason does bring up a good question. Warren Buffett, please tell me why I wear a ring on my pointer finger. I've always wondered. Explain yourself, Tom.
Do you guys actually want to know what this is?
Yeah.
It's just like a school ring that I've had forever.
Like a high school ring?
Yeah, a high school ring. I've talked about it a couple times on the channel, but not in a whole lot of depth. Probably the best thing that ever happened to me was getting into the high school that I went to.
Oh,
I was on basically on a full scholarship for school and board and food and uniforms and everything. It's a school that was set up in Auckland called Dilworth School, which was basically set up for like underprivileged boys, essentially. People in straitened circumstances is kind of what it said in James Dilworth's will in 1906 or whatever. And yeah, my dad actually had a kind of farm accident when I was kind of in my first couple of years of high school and managed to get into that school, and it was a great experience. So if you ever see the little like baggy green cap that sits on top of my bookshelf, you can occasionally just catch the side of it in some of my videos. That's actually my Dilworth School first 11 cricket, like a small version that they gave us for that. I was first 11 cricket captain at school, so that's
See, look at that! Look at that meaningful, wholesome answer.
so it was like halfway through high school that you got into this one that you got the ring from?
Yeah, I was in my second year of high school, halfway through my second year. Yeah,
cool.
Yeah, it's very cool. It's actually one of the reasons I really like what Pabrai's doing. I mean, it's almost like it's very similar to like a New Zealand version of Dakshana, although our cost per student are nowhere near as low. I don't think. But yeah, I mean, I think when I was there, the scholarships were costing like $35,000 per student per year or something. Like, there's quite a lot of money going into it. There's about 300 or so boys at that school, and it's actually quite an interesting investment story. Again, I've been meaning to do a video on this for quite a while, but the guy that started the school, James Dilworth, was like a banker and like farmer and property speculator in Auckland. And he'd moved to Auckland from Northern Ireland, actually, in the early, or I guess late 1800s. The school was kind of on his farm in the middle of Auckland, which is like a super developed area now. So other bits of real estate he owned just down the road are now like Ferrari dealerships that the school trust board rents out to Ferrari and stuff.
Wow.
And
so the school still owns the land then?
Yeah, he left a lot of land. I think in total it was like £100,000. This before the New Zealand dollar back then. And just last year they ticked over $1 billion in basically net asset value.
Wow.
All the while running the school and spending a bunch of money, every year to run the school. So it's quite a cool investment story as well, actually. An early lesson.
I would have no idea. It's that huge. That's crazy.
Yeah. I think it's the biggest trust board. I think it's the biggest trust board in the Southern Hemisphere, I want to say. Maybe that's not true, but definitely New Zealand.
I mean, it's hard to beat $1 billion. That's ginormous for a school.
Yeah. Yeah.
Well, that's neat.
That's
please
the
do
ring.
a video
there
on
you
that.
Go.
That's the ring.
We need pictures. We need a nice presentation. That'd be fantastic.
Yeah.
Well, there you go, Jason. Are you satisfied?
Are you not entertained?
I'm satisfied. that I think that's a good spot to wrap up. We're well over an hour now. Frank's out. He was moved.
Yeah, Frank pieced.
He was moved by that story, and he's out. Nah, Frank's got little.
He's on baby duty.
Yeah, he's got a little person to deal with.
Mini Frank.
Yeah.
Yeah.
Well, with that said, we got a pretty good turnout here. We're up over 80 folks on the concurrent stream. Oh, here's Frank to help us say goodbye. He's back.
It's a 2-year-old fault, not mine.
Yeah. Sure. Whatever you say.
But you can, in a few years, you can show them this video and relive all the memories.
The overtired 2-year-old problem.
He's going to be a big investor. When are you going to teach him how to invest?
He's going to be a crypto investor, probably, right?
I hope not.
To spite you.
He might be a macro guy.
It's like, pure commodities futures trader. It's like an 8-year-old. All right.
What would you do? What would you do if he started like a razor company, Frank? Would you test the products?
I'd have to test them out.
Yeah. Okay.
Marketing campaign.
Yeah. He just goes full barber. All righty. Well, thanks everyone for stopping by. Always a pleasure. Always good when we have the full crew as well. So that will not be the case next week. Tom, safe travels and enjoy the trip. That'll be cool, and we're looking forward to seeing the highlights. And everyone else, like, comment, subscribe, all that great stuff. Check out the fantastic links down in the description, including those discount links to Seeking Alpha and ShareSite, in the Discord link as well if you're not already in that. With that, take care, everyone. See ya.